Other questions? Thank you.
I would question that because the tips, the appreciation is treated as taxable income.
Yeah, actually,
I would only.
You know, you're exactly right. I'm sorry, you're exactly right. I keep forgetting that. I made a mistake. You're correct. A problem with tips is that if the indexation, if inflation reignites and that indexation becomes a significant component of your return, thank you very much, even though you haven't received that cash yet, that's a notional value that you're going to get on future coupons and when it matures, that tax, even though it's just an accrued concept, you haven't gotten cash, you'll be taxed on it. Now that's not as horribly, unless we're talking about a 10 or 20-year investment, it's not really as bad as it sounds. You might be paying some tax a year or two ahead, but it certainly would offset the advantage I was talking about. So if you put them in an IRA, that's no problem. If these tips are held in an IRA, you don't pay money until your money is withdrawn, whether it's in a tip or no matter what it's in, it's all based upon withdrawal. So that would argue to put the tips in the IRA, and it was a very good point you brought up. But I worry about putting the tips in the IRA because, you know, if taxes are 5% or 7% at the state level, that's going to be priced into those yields. And I worry that you're losing that state tax advantage. So you could argue either way, but certainly for a long-term tip, you would not want to hold that in anything other than a retirement account. That's an excellent point. Did I capture it correctly? Thank you for bringing it up. And I apologize for getting that.
Why do you think CDs are better than treasuries for laddering?
Well, part of it is in today's environment, they yield better.
Because of just strictly yield. If it was the other way around, then you'd
yes.
treasuries.
Yeah, in today's environment. But they usually do yield better. There's been times when it's not true, when the banks are really flush with money and CD banks, the yields are pretty low. But they, generally speaking, the best CD yields in the country are well better than treasuries almost all the time.
But again, you'd have to factor in state tax.
Yes, if you held them outside of your retirement account. If they're inside your retirement account, you don't.
Outside.
Good. Any other questions or comments? It's an obviously educated audience, better educated than me here. Anything else?
You didn't mention munis when it comes to return.
Oh, excellent. Yeah, excellent point. Outside of your retirement account, you might, if you're in a high tax bracket, want to consider municipal bonds. If you're in a lower tax bracket, you don't want to invest in municipal bonds. Why? Because you're throwing away the tax advantages and you're getting the lower yield. So you only want to do this if you're in high yields. The problem is that most municipals tend to be long-term. And if they're long-term, then this really isn't the risk-free asset that we're talking about. And another problem, of course, is how risk-free are municipals. So this would really refer to short-term municipal securities, and there's not many short-term municipal securities because municipalities want to borrow long-term. So they have these short-term muni market funds, and I, generally speaking, wouldn't recommend those for anything other than the very small, most liquid amount of money that you have. I guess that's a tough one. This one does not fit neatly into the model. It's a good point. It's a good point. I personally invest in municipals, but you're taking risk when you do it, and it wouldn't fall into this category. It would actually fall into the next category, which we'll go to right now. What is the market portfolio? What was this point in tangency, this other asset in which you ought to put the part of your money for risk? And it contains all risky assets. Now, not really all risky assets. What do I mean by all risky assets? They need to be market traded. And this is a key point. If we go back to that roulette wheel, you say, well, you know, that roulette wheel was different because that was all based upon randomness, and investment returns aren't random. Well, actually, modern portfolio theory assumes that's exactly what investment returns are. They are random. So, for instance, I might pose the following question. Would you rather invest in a stock in the United States that's traded on a major market that has excellent management, an excellent history of paying increasing dividends, is a product leader, market share leader in a growing industry, Or would you rather invest in stock B? Pathetic management, ethics problems all over the place or something, losing money. I'll pick the company. It's not ethics problems, but Eastman Kodak. You know, just down the drain, down the drain. Which one of those stocks is a better investment right now? And it just seems logical that the company with the great management, the Apple computer, has got to be a better investment than the Eastman Kodak. But then let me ask the question this way. Suppose we're going to talk about sports betting. And I said, let's take the baseball team. It's the very best baseball team. You know I'm talking about the Yankees here, right? I heard there's an interesting area where there's a lot of Yankees fans and a lot of Red Sox fans. All right? So you smart Yankees fans know what I'm talking about. If you took a baseball team, I'll pick it this year, if you do follow the American League at all. The New York Yankees right now have the best record in baseball. And who has the worst record? You know, you don't follow it closely. All right, the Baltimore Orioles have the worst record. So you say, am I going to pick the team that's got the best pitchers, the best win-loss record, and the best batters, or am I going to pick the team that has the worst record in baseball, the worst batters, and the worst pitchers? Lowest payroll, lowest attendance, lowest everything. Which one should I bet on? And most people that are familiar with sports betting say it doesn't matter. Why doesn't it matter whether you bet on the best baseball team or the worst baseball team? The point spread or the odds adjust. People familiar with sports betting, and most of my college students, it's scary. Most of the college students, you know, they're into sports betting. I wasn't when I was their age. I'm not into it now. But they instinctively know that the odds adjust to reflect that. Open up any newspaper, you'll see the lines, you'll see the odds in these things. If New York is playing Baltimore, depending on the pitchers and location, you might see the Yankees as a 2-to-1 favorite, or even almost a 3-to-1 favorite over Baltimore. That means that you have to bet $3 just to make $1 win if you bet on the Yankees. But if you bet on Baltimore, you only bet $1 to make $3. So the odds adjust to reflect that. And in that theory, what happens in sports, and I have studied this empirically, what happens in sports is that the odds adjust so that it really doesn't matter which team you bet on, the best team or the worst team. And that's what modern portfolio theory is saying about stocks. We've got millions of people with incredible models and information and listening to the analysts and the conference calls, studying these stocks, and as outrageous as it may seem, the theory says that whether Apple Computer is going to go up or Eastman Kodak is going to go up is an equal bet because they're both random. All existing information is included in their price, and their future price changes depend upon new information, and by definition, new information is random and neutral. So I look at Apple Computer. What is it now? $3.50 a share? Something like that?
No.
$2.50 is that all? At $2.50 a share. And the modern portfolio theory would argue that those two assets are both priced equally attractively. Now, that's not palatable to a lot of people. I urge you to take that argument seriously. So you're going to hear people arguing that, well, the U.S. is the place to invest, or maybe India is the place to invest. You're going to hear people arguing that value stocks in the U.S. are better than growth, or vice versa. The airline industry is worse than the tech industry. You're going to hear people arguing that Apple is better in the tech industry than IBM. You're going to hear people arguing that now is better than next week. Fridays are better than Mondays. You'll hear all of these arguments. Well, if you were to go to a roulette table in Las Vegas and stand around a roulette table, you would hear the same arguments. Everybody's got their betting strategy. And what modern portfolio theory is saying is that it's a perfect analogy. That they're both random events, and that we are just human beings reading into randomness what we want to see. We want to believe. Oh, how we want to believe. I have these dreams too, that I could somehow figure out, you know, how to beat the casinos, or to beat the lottery, or to beat the stock market. But Modern portfolio theory says the best way through time, and in my career, the evidence that I've seen is that the best way to play this is to buy everything. Now, when I say everything, there are some limitations. It needs to be market traded. If there's an asset for sale, it doesn't mean that it's a fair price. The only way that we can know an asset is trading at a fair price is if there are numerous well-informed buyers who want to buy it and numerous well-informed sellers who are willing to sell it. And I especially look for securities in which it is legal and possible to short sell the security. I wouldn't invest in a market that you can't short sell. Short selling, for those of you that might not be familiar with the jargon, is a negative bet that you can take on an asset. Well, if you can only take positive bets on assets, they can get overpriced. It used to be there was a law in this country that you couldn't short sell assets that traded under $5 a share. So I wouldn't touch a stock under $5 a share. It might be a fraud. Well, this law is no longer true. Would I buy a stock at $3 a share? Sure. Don't I worry that it's overpriced? No. Because if it were overpriced, these analysts who know so much about those companies and are researching those companies would short sell it and would drive it down below 3. And I have so much confidence in that competitive pressure that I simply accept that in a well-functioning competitive market, it's smarter than Don Chambers. I'm willing to simply accept that if the market says it's worth $3, it's worth $3. I put it in my portfolio.